In 2012, we had a global economic slowdown, but we actually saw equity markets do very well right across the world. And I mean, that might sound like it's a little at odds with one another, but in actual fact, I think it reflects the fact that investors are forward-looking. And while they were seeing slower economic growth, they also saw central banks injecting liquidity into the financial system. They saw interest rates coming down. They saw governments introducing new measures to support their economies. In Europe, we actually had real progress to dealing with their financial crisis. It's far from over, but we actually saw some improvement. There was signs that while China was slowing down, that a soft landing was taking place. So forward-looking financial markets anticipated that ultimately this year would be a better year. And I think that's one of the reasons why we saw double-digit gains in most equity markets around the world last year. Every day you're sitting in cash, you're losing money because the return on cash is less than inflation. If you look at bonds, bond yields are so incredibly low that the scope for making capital gains on bonds is very, very limited. And in fact, if there's any risk, it's that you could have a backup in yields that would actually reduce the value of your bond exposures. I think that corporate bonds continue to look attractive when government yields are so low. But at the end of the day, the dividend yield on the S&P 500 is now higher than the 10-year government bond. And keep in mind, you get better tax treatment. So in actual fact, dividends are way above government bond yields, and that basically tells you that without a question, equities are going to do better than bonds. The real question is how much better. I think 2013 is going to be a bit of a year of transition. I think that we're still only going to have growth of around 2%, but that's going to reflect the fact that while the private sector is getting stronger, we are going to see fiscal policy from the government become restrictive. But then I think in 2014, we're actually going to see signs that the US economy is going to be growing north of 3%. Well, add on inflation, that means income in the economy grows at north of 5%. It means equities should be delivering a high single-digit return. So I do think that Europe will navigate its way through the financial crisis. I do think they're moving in the right direction. But I would expect that at some point, at least a couple of times this year, financial markets are going to worry once again about Europe. And that's when you get bouts of volatility. So I do think that there are some risks out there. I think one of the biggest risks that are out there is the fact that an awful lot of investors have put their money in fixed income assets in recent years because it was a safe place to be. But as far as I can tell, the balance of risks are all now skewed to one direction. I think that we are definitely going to need portfolios to rotate towards equities and out of fixed income, because the risks in fixed income right now are enormously high over the long haul. Housing is finally showing signs of stabilization. I think we are going to see price growth. A number of the major markets have in fact turned. The markets that are still lagging, places like New Jersey, a lot of it has to do with the fact that it's been more difficult to deal with foreclosures in those markets. If you look at places like Florida, where the process of dealing with a foreclosure happens relatively quickly, those markets are coming back faster than the rest. But over time, I think even in the states where they are having foreclosure issues, ultimately the drag will become less. So I do think that we are going to see housing prices rise. I think that housing will deliver positive gains and add to personal wealth as we go forward. And after all, it is the single biggest asset that Americans have, so it's a very positive thing. And in fact, the turn of the housing cycle is unambiguously positive for the economy as a whole. I think commodities are also going to be well supported. I would say that I don't expect oil prices to go over $100 on a sustained basis. I think that really oil is going to trade in the high 90s on an ongoing basis for West Texas Intermediate crude. I think Brent will probably be in the 110, 115 range. So that's very economic for oil companies. I think we'll see natural gas prices creep a little higher. I think base metal prices will get good support as the Chinese economy recovers. So we're not going to get the sort of commodity boom that we had in the years preceding the financial crisis. But from an investor point of view, I do think commodities will look attractive.